Have you ever placed a trade with the perfect strategy only to watch the market hit your stop loss and then reverse in your original direction? You're not alone, and the problem isn't always your strategy, it's stop loss hunting. In today's deep dive video, we're going to uncover what stop loss hunting really is, why smart money uses it to their advantage, how to identify zones where hunting happens, the psychology behind your repeated stop-outs, and most importantly, how to survive and profit despite it. This video could completely change how you place stop losses and how you look at charts forever. Let's get started. What is stop loss hunting? Stop loss hunting is a strategy used by big players to trigger retail traders' stop losses, collect liquidity, and enter large positions at favorable prices. Let's be clear, it's not always illegal or manipulative. It's how markets operate when large players need to find enough volume to execute massive trades. How it works: retail traders place stop losses just below support or above resistance. These areas become liquidity pools. Smart money pushes price into those zones, triggering stops. Price then reverses, leaving retail traders stopped out and confused. If this happens to you a lot, you've been hunted. Understanding liquidity, the root of it all. Liquidity is the fuel of the market. It's the ability to buy or sell without causing huge price changes. For institutions, executing a $100 million order requires many counterparties. Stop loss orders provide that counterparty liquidity. So, institutions look for clusters of stop losses, pending breakout orders, herd behavior. These zones become targets, not because they're evil, but because that's where the money is. Why smart money hunts stops? 1. To enter large trades. Institutions need lots of volume to enter a trade without slippage. Retail stop losses equals instant supply, demand. 2. To trap retail traders. They create fake moves to trigger breakout entries, stop losses, then reverse and profit from the chaos. 3. To manipulate price structure. By clearing swing highs, lows, they create clean charts. Remove opposition, prepare for the real trend. Where stop loss hunts usually happen, knowing where the hunt happens is half the battle. Here are high probability zones. 1. Below swing lows, above swing highs. Traders place stops here, making them magnet zones. 2. Around support and resistance. The more obvious the level, the more likely it's a trap. 3. Trendline breaks. Retail traders place entries and stops around trend lines. 4. Near news events. Volatility allows for sudden stop hunts in both directions. 5. During low liquidity hours. Asian session and pre-London hours often see fake moves. How to survive stop loss hunting? Here's the good news. You can beat this system by adapting. 1. Stop using obvious stop loss levels. Don't place SALs just below and above support resistance. Use wider or strategic stop placements. Better yet, wait for confirmation before entry. 2. Use smart money concepts. Mark liquidity zones and order blocks. Understand market structure shifts. Trade in alignment with institutional footprints. 3. Enter after the hunt. Wait for the stop hunt to occur. Look for rejection and engulfing patterns. Then enter with the institutions. 4. Use time frame confluence. Watch how higher time frames align with LTF traps. A hunt on 15 meters might be part of a larger for H accumulation. 5. Be patient and trade fewer setups. Stop jumping into every signal. Focus on high-quality, post-hunt trades. Stop-loss placement techniques. Place stops beyond structure, not inside it. Example: if support is at 1.200, don't place SL at 1.1990. Place it at 1.1970 where it's harder to hit. Disclaimer: This content is for informational and educational purposes only and should not be construed as financial advice. Always do your own research before making any investment or trading.